Welcome to the latest in the full FX Disruptor Series with LMAX Group, and as ever I'm delighted to be joined by David Mercer, CEO of LMAX Group, with, if I may be honest David, a slightly better backdrop than we're used to in West London.
Indeed, it's great to be back in your hometown, Colin.
Overnight, actually, as we're recording this, LMAX Group released its 2021 full-year results. I was going to make some remark about the fact you've come to the other side of the world, you were that optimistic, but they were actually fairly good. I mean, you must be pleased with them.
Yeah, very pleased with them. But, look, we did record ever EBITDA, record ever revenues and volumes. EBITDA came in at $62 million. Pretty good, happy with that. But as you know, that's now a history book.
Yep.
It's taken the accountants about 10 months to agree with what I knew last December. And you're only as good as your next trade or your next year. So for me, it's all 2022. But the results in 21 were all about the efforts we put in the 2 or 3 years prior to that. And it will be the same in 22, 23 and 24.
Yeah, it's about building.
For sure.
Yeah. So we are obviously, with our beautiful Sydney Harbour backdrop. I thought it'd be a good idea to actually get your perception of how the business is going in Asia Pacific more generally, because I've long said this is an important region.
Yeah, I think it is. I think like every sort of BIS survey says that 25 to 30% of business originates in Asia, and yet risk desks are in New York and London. Matching venues are in New York and London. So I think we need to get the matching engines and the risk desks closer to the origination. If you were designing market structure, that's what you'd do. So I've been very surprised that the legacy venues have pulled out of places like Tokyo. So we're unique at LMAX Group right now in that we've got matching engines in London, New York, Tokyo, and Singapore. That's now unique in foreign exchange.
Yeah.
So I think in terms of price discovery going forward, you're going to have a twin hub, like an Asian corridor, which is between Tokyo and Singapore. It's going to take time to build.
Yeah.
All the market makers will tell you that right now. There's been various incentives by the MAS. They're very progressive. They want Singapore to be the hub of Asia Pacific. It's harder to move the takers. So they're used to matching in London and New York. And to be honest, they're used to matching in Tokyo. I think Tokyo will always have its place, obviously for yen and all yen crosses. And I think the significant Japanese banks. But I think there's room for an Asia-Pacific hub that is Singapore. So I'm looking forward to it. No, I haven't left out Sydney, but it is a long way away.
But long way from anywhere, I can tell you that.
So maybe we end up with a triumvirate. So maybe it's Tokyo, Singapore, and Sydney. But to start with, I think in the next 5 years, you're going to see this Asian corridor develop. Yeah. And certainly at LMAX Group, we firmly believe in it. I've got offices and staff in Tokyo, in Sydney, in Auckland, in Hong Kong, and in Singapore. So that's our commitment to the region. And I'm rather surprised that the so-called competitors of mine are pulling out of the region when it would seem that there's a lot of flow down here, a lot of origination down here. And if you look at the weight of money that's coming from China and Chinese territories, you'd expect to be closer to that region.
Yeah, and I guess actually to your point on Sydney, Sydney to Singapore or Sydney to Tokyo is a lot shorter than Sydney to London or New York still. So there's still a round trip improvement there.
For sure. Look, to be honest, it is marginal, but it is noticeable. Look, risk desks are still primarily in London and New York. You can't get away from that. But slowly they're moving to Singapore. So I think it will be advantageous to all going forward.
Yeah, yeah. Now, more broadly, we exist in a world where foreign exchange volatility has become not only quite high, but actually prolonged and sustainable. I guess that's had a positive impact.
Yeah, I think if you walk around the city, any city in capital markets, all the guys in FIC are happy they're all having a good year. Rates are back.
Yes.
So, it's a triple whammy this year. You've had Russia, rates, and recession. So whilst that's not good necessarily for the planet or for the world, it is good for foreign exchange. We've been in a period probably of a decade where you have very sporadic volatility. This year it's been sustained.
Yeah.
I think the policies in the US, which seem out of kilter with the rest of the world, make the dollar is, ridiculously strong, which means there's a lot of whippiness in every other market. So look, it's good on the FX side of the business. It's great for us. It's great for everyone. And I think it's, it makes the foreign exchange market more interesting again and more relevant. So for a long time, people were saying, well, is foreign exchange that relevant? What does it matter? Rates are at zero. What does it matter? Well, no, it does matter. And suddenly people are seeing the effects of interest rates, because going way back when we learned our trade, FX was driven by interest rates. Hasn't been for a decade. Now they're back with a vengeance. Well, not really with a vengeance. I mean, the dollar's still only 4% or something. That's still historically low from when we started. But yeah, look, I think it's exciting times, but it's also difficult from a corporate perspective. That the inflation, the recession side of it, all of us having some business in Eastern Europe, be it in Russia, Ukraine, that's been awkward. But on a pure sort of capital markets basis, I mean, it's 22 has worked well for the FX guys.
In these sort of environment then, does technology performance become even more important? Because I would argue the last 10 years has been the outlier in foreign exchange history.
Sure.
As in, not a lot going on, bursts of activity.
Yeah.
Now we're in this sustained, as you say, interest rates aren't going back to zero for any time soon. So does this make technology performance of your platform even more important than it has been possibly for much of the last decade?
Yeah, and I must be honest, because you're seeing, technology is core to everything we do at LMAX Group. But I'd also argue it's core to the heart of any business in capital markets, right? So this word fintech, I've got to tell you, the best fintechs in the world are probably banks, right? And the proprietary trading firms that are out there trading. Because if you're not good at your tech, if you haven't got scalability, if you haven't got high throughput, if you're not paying attention to low latency and stability, then you're not going to succeed. So what I've seen this year is order rates going up by 20, 30%. Now, the good news is every time you build tech, we go for 5x.
Yeah.
But typically you don't need it. This year in 22, around those spiky moments of the Russian invasion and what was happening in dollar yen, the Bank of Japan's intervention, what you see in sterling, all of a sudden order rates were, for sustained periods, double or triple what we saw as the norm in 21. So yeah, constant investment in technology is key.
And that's the key difference, isn't it? That these spikes are coming for sustained periods, not just a number of seconds.
Yeah, it's not just 1:30 first Friday of the month. And in fact, that hasn't even, if you look at that, payrolls haven't been very important for the last 3 or 4 years. Everyone's kind of ignored it, right?
Good point.
FOMC meetings, who cared? I mean, nothing happened. It was just the market barely moved, all priced in, right? Suddenly, you're talking not just quarters of basis point, half a basis point, 3/4 of basis points the last time. You're going to have percentage moves. And then, seriously, in the old days, on the floor, it would have been noisy as hell. Don't know how you guys ever got trades done. But that's actually what's happening in this electronic world, because everybody's reacting at the same time. We process probably 7 billion orders a day. At times that goes up to 10 billion, and you're processing hundreds of thousands of orders in every second now, right? So, and it's been going on for days at a time. So yeah, we've paid more attention to scalability and stability than we've ever done in 2022, because this could be the next decade, and long may that continue.
I suspect it will be. On the subject of disruption, if we go back too many years that we want to remember, one of the disruptive forces of LMAX exchange was no last look. Now, obviously, there were what you call legacy venues had that as well. Something I'm quite interested in is I'm hearing a lot more about, are we going code-only liquidity, or we're defaulting the code-only liquidity, which I think is a great thing. Do you feel that the industry's finally come around to your viewpoint?
Yes and no. I think they like to think they have. But in some ways, they've stolen the terminology of central limit order books. So there's a lot of talk now about firm. No, firm is streamed limit order liquidity. Firm isn't zero hold time.
Yeah.
By the way, what is zero? Okay? What is zero? At LMAX, you can cancel and replace an order, depending which venue you're on, between 50 and 80 microseconds. So, okay, not everyone has to understand microseconds. What that means is you can change your price in euro-dollar 20 times in 1 millisecond, 20 times. So zero hold time, what's zero? Is it 0 mics? Well, that's impossible. Is it less than 1 millisecond? That's probably reasonable. That's what everyone views as zero.
Okay.
But that's 20 times. So all that's happened is we've moved, in the 10 years I've been talking to you about this, we've moved from 100 millisecond last look times to 1 millisecond last look times. So that's all. Now, don't get me wrong. I mean, people often say, oh, David, you can't be so anti-last look. On a bilateral basis, you can have any agreement you want with your customers. And I think it's fine. Honestly, you might say, depending where someone is set up geographically, depending what someone's tech stack looks like, depending what shapes and sizes they want to trade in, you can say, I need 5 milliseconds as a liquidity provider. But I think when my competitors, my venues to say they're code compliant, by the way, look at the small print, except unless you say you don't mind having non-code compliant liquidity. I mean, surely that's the very least, right, you'd expect in a public market, in a public venue. So, and yeah, look, people come to me all the time now and say, oh, it turns out you were right. I don't think that's the case, actually. I just think that they've waited a decade and the technology has sped up. So we've moved from 10 milliseconds being good to 1 millisecond being good. And I still look at my competitors that people call at times the primary venues. Primary venues do not exist in FX markets, right? The legacy venues that were the biggest, they send out snapshot market data in every 5 milliseconds. That's a history book, Colin. It's a history book. We send out firm, streamed, limit order liquidity, right? So we'll probably update 5 times quicker than these guys. So for 4 milliseconds, they're wrong. So look, I think on the positive side, I'm happy that the foreign exchange marketplace is more transparent than it's ever been. It's fairer than it's ever been.
Yep.
That most of the big names have signed up to the code. Hats off to the guys that were involved in the code. I would have liked them to go a step further and say firm, streamed, limit order liquidity is the way forward on public markets and do whatever you want on a bilateral venue. They haven't done that. But maybe they will within the next decade. My job is to keep convincing people that the best way to trade, the most efficient way to trade, the most consistent way to trade, and the best way to have certainty of execution is on central limit order book, central limit order books in general, and LMAX Group overall.
And there was me hoping we were going to say, yeah, we've done last look, we were right all along. Never mind. We'll keep battling. I suppose it gives me something to write about. I guess to close out, I'd just like to close out just briefly if we can. So David and I are going to be speaking in Paris, and this will be a bigger theme there.
In French.
Peut-être. And I just thought, some high-level views on what's happening in crypto at the moment, because obviously LMAX Digital had a great year in 2021.
Yeah.
What's happening in 2022?
Yeah, tough year in crypto, really tough year. And LMAX Digital will be no different. We're investing more than ever. We've got more staff than ever. We're fully committed to crypto. I think it's going to change the face of a lot of capital markets in the decade to come. But look, the asset price is off 60% off its high. On an average basis, it's 50% off what it was last year. So if you want to look at dollar volumes, then we're going to be affected. When your business model is asset price times basis points, then guess what? 22 isn't going to be as frothy as 21. But what I would say, look, 21 was, in FX parlance, was probably overbought. 22 is probably oversold. It's a risk-correlated asset, it being predominantly Bitcoin.
Yep.
So Bitcoin and Ethereum are probably 70% of the market today. So when there was a sell-off, all risk assets were sold off earlier on in the year. Bitcoin and crypto was no different.
Yep.
So that's it. But the large institutions are showing more commitment than they ever have in 2022. You're just not going to see it in numbers.
Yeah.
You're not going to see it in LMAX digital numbers. You're not going to see it in crypto out there. There's also been a few, let's just say, poor events in crypto. So you've had stable coins that didn't work. You've had a few of the repo desks, the lending desks that clearly didn't understand credit risk going into liquidation. So that's tarnished crypto a little bit. But the good companies in crypto, and there are many, and there's some great scientific ideas coming out of crypto, will just get stronger. I liken it a little bit to .com, right? So Amazon, I think at the time, traded up at $111 and then traded down to $7 at the peak of the .com crash. It was a good company, right? And it had a good business model. It existed. So LMAX Digital, for one, will exist, and a lot of other ones will exist out there. I'm still extremely positive about what happens in that market over the next 5 to 10 years. But 22 and probably most of 23 is going to be difficult. And it's driven by two things. I know I've talked to you about it before, but it's lack of regulatory determinism and lack of credit mechanisms, which means both of those mean that there's not that wave of institutional money coming into the market just yet.
Yeah.
They're waiting, they're ready, but we need those two things to be improved before we see the next really bull marché, as you'd say in French.
Luckily, you've got FX to keep things ticking along anyway in the background.
Few.
Who'd have thought we'd say that a few years ago, yeah. David, as always, great to talk to you. Thanks for actually visiting my town.
It's fabulous, isn't it?
And we'll see you again soon. Everybody, thanks for watching, and we'll be back with a new Disruptor Series probably in the new year. Thanks a lot.